Buried behind the headlines regarding war, inflation, and gas prices, there is a massive super crisis developing as we speak. The American housing emergency. Prices that were already insane in 2021 only keep going up, and in today's video, we analyze the newest facts and data looking into what the future holds in regards to America's insane housing market. For the millions of people looking to purchase their first home, this video is for you. We start with the obvious. The median price of a single-family home in the United States has increased from $290,000 in late 2019 to $389,000 in March of 2022. In just over 2 years, that is an increase of 34%. In hot markets like Austin, Miami, Tampa, Phoenix, Vegas, and dozens of other up-and-coming cities, the numbers are a lot worse. Many who believed that this bubble would pop months ago are growing frustrated that it's now year 2 and prices are still getting worse. As I mentioned many times before on this channel, it's easy to get emotional about the market, especially if you're a buyer. I've maintained a straightforward opinion about the future of housing prices by saying that this is only the start. While that may not be what you want to hear, there is plenty of evidence that suggests prices will never return to pre-COVID numbers. Here's the truth. Let's go back to the last housing bubble, which peaked in July of 2006. If we look at prices from the decade before that, we can spot something interesting. The market is more than just the average price because most people are buying homes with loans and they're paying for those loans with the income they earn. When loan terms change and income changes, it's unfair to compare pure numbers as they don't take into account these gradual changes. You'll see what I mean in just a moment. As you're well aware today, investors face a dilemma. Inflation is at its highest point in 40 years, the Fed is going through a phase of aggressive monetary tightening, and top firms predict stock market returns under 5% until 2035. Restructuring your portfolio has never been more difficult or more crucial. So where can you turn? Well, we all know I've been advocating for alternatives for years, and they've done pretty well for me. And it seems like people are catching up, as a recent JP Morgan report declared alternative assets are no longer optional. In light of this new normal, certain platforms have arisen, giving access to top alternative asset classes. There is one in particular that seems like a no-brainer to me. It's called Masterworks. Masterworks.io has solidified itself as the platform for investing in contemporary art. They let you access their exclusive investments from names like Banksy, Monet, and other iconic artists for just a fraction of what billionaires pay to purchase, because roughly 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art, in part to diversify, and because it's a natural inflation hedge, it makes sense. After all, contemporary art pieces outpaced the S&P 500 by 164% from 1995 to 2021, and have exhibited the lowest correlation to equities of nearly any major asset class. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors, and their new offerings usually sell out in hours. 30% plus, that's wild. If you want to get in on it early, all you have to do is go to masterworks.io, create an account, check out what they have, and invest in their offering. And my subscribers get to skip their wait lists using the special link in my bio. Please check it out. Now back to housing. Here's where I was going with my pricing argument. In 2006, the median American household had an income of $50,200. Today, that median is $67,000. So comparing prices in the past isn't exactly fair when the average American today makes almost 33% more than the one in 2006. And it doesn't stop there. From about 2001 to 2006, the average 30-year mortgage had an interest rate of 6%. That is almost 2 times more than what people are likely locking in today. In recent memory, rates have hovered around 3%. So what does this mean? Well, it means that looking at a chart of the previous bubble is a bad comparison. Instead, we should look at affordability. What good is a comparison if it's diluted by messy data that has not been adjusted to changing conditions within the mortgage markets and job market? So to do that, we will assume the following to get a better picture. Let's say the Jones family was looking to buy a house in 2006 at the very top of the last bubble. The Jones family is average in all measures, and let's assume they make the 2006 median income of $50,000 and they buy the average 2006 house for $243,000. Their mortgage payment, assuming these variables and a 6% interest rate, would be around $1,500 a month. Now, if we take that number and divide it by their monthly income, we get 36%. The Jones family of 2006 buying a house at the peak of the market would spend around 36% of their income paying for it. Now that is an affordability measurement. But what about today? How do we look like in terms of this number? Are we close to the previous peak of 36%? To save you the boring math, I'll just tell you. Today, right now, with current interest rates, the affordability percentage would be 35%. Extremely close to the top compared to last time. So all of that work just to tell you that we're in a bubble, and based on results from last time, it should be very close to popping. After all, I just guided you along for minutes explaining how prices didn't matter and affordability is what we should look at. And after proving that today's affordability is similar to what we were seeing in the last bubble, it would only be reasonable to assume the bubble will pop sometime close in the future, mimicking the history. Well, not so fast. There are a couple of things that make this assumption false. Here's the main thing you have to understand about this problem. While people spending 36% of their monthly income on the mortgage may seem high, it pales in comparison to what we observe in countless other markets throughout the country. For example, in LA, the median home price is $915,000, while the median household income is $63,000. That means the typical family living in LA has a mortgage payment of around $4,700, yet only earns around $5,300 gross per month. That shocking stat suggests that the average family in LA is spending over 90% of their income every month on the mortgage. How is that even possible? If you look at the LA market from the outside, it should have crashed decades ago. It makes no financial sense that anyone can afford a home there. So what is going on? Well, we turn to Reddit, where this question was asked many times on the LA forum. Questions like, millennials that bought a house in LA, what do you do for a living? There are countless posts just like this, and the answer almost always comes down to two things. Rich people, which doesn't explain everything because not everyone in LA is rich, especially based on the median income level, which suggests most people are earning around $63,000 a year. So what explains the other gap? Well, it's money from parents, also known as an inheritance, and it's much more common than you think. New data from financial services company Legal & General found that 43% of homeowners aged 34 and younger got money from family. And I'm sure that percentage is much larger in LA County. So where am I going with all this? How is this related to the future of home prices throughout America? Well, if LA can have a thriving market with affordability so incredibly low, there is no evidence to suggest that 36% is the peak. Affordability, or the opposite of that, could still skyrocket throughout the states, and based on the LA market, it could even triple yet not crash. This is especially concerning when you look at inventory levels. At the end of the day, the market is simply supply and demand. Right now, we have massive demand, but a record low supply. In July of 2019, there were 2.4 million homes for sale. Today, that number stands at just over 1 million, meaning 2 times less inventory than normal. Nobody wants to sell their house, and can you really blame them? Being a buyer in this market is absolutely miserable. Homes receive dozens of offers, and most sell for well over the asking price. On top of this, we now have a growing issue that could rattle the markets for ages, something that nobody ever talks about. You see, mortgages as a financial instrument are actually really good deals for consumers. They are 30-year loans that you are free to pay off early, or when the rate falls, you can always refinance to something lower with really limited fees. Everyone who had a mortgage in the past few years took advantage and refinanced at record low numbers. Last year, the 30-year rate got to nearly 2.5%. That's unheard of. For the people who are selling their homes now, it's becoming harder and harder as rates have skyrocketed. Why would anyone sell their home now, a home with a guaranteed 30-year 2.5% rate, and get into a new home that you would need to buy with a 5% rate? It makes no financial sense. This means everyone who locked in low rates is very unlikely to sell, and is part of the reason we are seeing incredibly low inventory levels. At the end of the day, nothing will change unless we see a major improvement to this number. Without homes for sale or new homes being built, this market will challenge millennials for years, dividing them between those who own and those who don't. Sure, there is a case to be made that rising interest rates will definitely slow the market down, but believing that the market will rapidly depreciate by 30% to pre-pandemic numbers is highly unlikely. If you disagree, I would love to hear your opinion down below in the comments. As always, if you enjoyed the video, please don't forget to hit that like and subscribe button.